time for our special segment, Quarter Se Quarter Tak. We bring expectations from each sector. Today, Upasana is going to tell us how the expectations are in the consumer durable space. Upasana, over to you.
Consumer durable companies are expected to post mixed growth trends in Q1FY26. During the quarter, cable and wire segment witnessed a robust growth led by strong volume growth and price hikes. Now coming to EMS companies, this pack continues to outshine as demand tailwinds continue to drive growth. On the flip side, AC players are expected to witness a weak Q1 owing to delayed summer and early monsoon disrupting their overall sales. Now coming to cable and wire players, strong growth momentum is likely to continue and exports are expected to pick up. Cable and wire volume growth is expected in mid-teens, indicating a solid start to FY26. Strong execution of government-led projects, steady demand from real estate projects and a pickup in exports should drive robust growth during the quarter. Now, Motilal Oswal estimates aggregate revenue growth of 17% in Q1 FY26 versus 11% seen last year amongst these players. Given the volatility in the commodity prices during the quarter, it estimates cable and wire margins likely to be flat on a year-on-year basis around 11.3%. Now, amongst the players, Polycab is expected to report highest growth of 17% on a Y-on-Y basis, followed by KEI Industries at 18%, while Havells and RR Kabil is expected around 15% of a revenue growth on a Y-on-Y basis. Now, Motilal expects margin expansion for Polycab and RR Kabil, while margins are likely to contract for KEI Industries and Havells. Now, coming to RAC and other appliances segment, weak summer affected the demand for RAC and other summer products. Industry demand for RAC is estimated to decline by 20 to 30% in Q1 due to high base, disrupted summer and even aggressive channel stocking seen in Q4 FY25. Industry leaders such as Blue Star and Voltas full-year growth guidance remains intact as they are hopeful of making up for the lost demand. Also, Motilal estimates UCP segment revenue to decline by 16% for Voltas due to decline in their RAC and air cooler category, and 14% decline is what they estimate for Lloyds. In ECD segment, Kotak estimates 5% growth for Havells, while Crompton expects a decline to be offsetted by double-digit growth in pumps and appliances. Now, coming to the main EMS companies, they are likely to outshine with their strong revenue growth trajectory and aggregate revenue growth of nearly about 51% on a Y-on-Y basis in Q1 FY26. This is mainly aided by healthy demand across end-user industries and even strong order book execution. All EMS players are likely to report revenue growth, barring Syrma SGS. Dixon continues to lead the pack with strong and anticipated revenue growth of 82% on a Y-on-Y basis, followed by Keynes at 50% and Sign DLM at 7%, and lastly, Amber is estimated around 6% on a year-on-year basis. Overall, EBITDA margin is likely to contract for this pack by 10 basis points on a Y-on-Y basis, led by margin contraction in Cyan DLM and Amber. So let's see what holds for consumer durable as a category, but overall we are expecting a mixed growth trend.
Okay, all right. Thanks a lot for that, Upasana. Well, we have Praveen Sahay, the research analyst at PL Capital, who joins us on the show. Hi, Praveen. Good morning. Thanks a lot for joining in. Well, first up, we have some news flow on Dixon overnight with regard to that JV that they've done and that small acquisition as well. How does it change things for them? If you could put a number to the EPS upgrade you could see, say, in FY27?
Yeah, hi, Nigel. So one thing is Dixon is not under our coverage, but entering in the component that will first make them a backward integration, and definitely that will add to their profitability from here on. So, yeah.
All right. Okay. All right. Let's focus then on, the quarter numbers itself. If you had to pick an outlier in terms of a positive surprise, which would that stock be from the coverage universe?
Yes, so wire and cable companies are expected to deliver very strong numbers in terms of the volume as well as improvement in the margin. So Polycab is one of the company which expected a top line growth of around 18.5%, which is a mix of domestic wire expected around 20% growth in their revenue, led by the largely volume. And similarly, that the KEI also expected around 17% of a growth on the overall basis. Their wire and cable also expected around 20% of a growth. So these are the the wire and cable companies are expected to outperform in the spike, whereas RR, which is more on the wire-based company, expectation for the growth is around 15% for their wire and cable. Overall, they are expecting around a 12% of a growth in their top line for this quarter. Even there is an improvement in the margin profile because the copper prices, if I look at, has been quite a firm for this quarter versus the last year first quarter. So that is the reason there is a good improvement in the margin, and we are expecting the profitability for RR to improve by around 32-33%. And so as for the Polycab and KEI is on the little lower side because the margin expected to be maintained on the YY side of 10.3, 10.4%.
But broadly, the wires and cables will have a good quarter. But they're also expensive. So between KEI, RR Cable and Polycab, which stock offers the best risk reward at this point?
Yeah, you are right. They are now run up quite significantly post correction due to a news of a new entrant. If I look at Polycab, it's trading at 36 times FY27 earning, 35 times for KEI, considering KEI 23% of earnings CAGR and 18% CAGR in the Polycab. My prefer here is a KEI because a KEI is a more on the HT or the LT cable based businesses, as well as extra high voltage segment to kick in from 27 for a KEI, and that will be a higher margin and also will drive the top line for them. So I think KEI is a better placed at this point, trading at a 35 times, and our target multiple is around 40. So there is some good upside in the KEI. Versus other two, whereas RR is trading at around 30 times, and I believe the maximum 32, 33 times is a peak for the RR, looking at the volatility in the business.
Voltas, which operates in the room air conditioning market. Now we know that Q1 was a tough quarter on the back of this unseasonal rains, but that's well documented. The stock, in fact, is down 22% from the start of the year. Is this a good buying opportunity? Do you see the cycle turning and things improving, from a demand point of view? Not backward looking in Q1, but just looking ahead for Voltas.
Yeah, sure. So for Voltas for the RAC segment, there is a one event lined up for the 1st Jan 2026. That's a BE norm change, and that will further increase the cost by 800 to 1,000 rupees. Now the summer has been very bad. Now there is a pressure on the the brands to liquidate their old inventories as well. Usually Q3 is a quarter where the most of the inventory filling started for the summer, next summer. So I think Q3 definitely they will bring the volume, but the margin may be at a pressure because of a liquidation, because the offers and discounts they need to give. Because in the past quarters we had not seen even a tough quarter. There is no much discounts or scheme were there. So I think the margin is under pressure, will be pressure the way forward. And further, if all things is eyeing on the next summer, if that will be not so great in terms of the prediction, then there would be a pressure on the margin further of increased cost, how they are passed on. So I think we need to wait for a Voltas for the next 2 quarters at least, especially looking at the scenario in the industry. Also, I can highlight over Voltas that their project business to somewhere is quite volatile because of international projects. There are some hiccups they are facing in. So I believe I think we need to wait for 2 quarters, and then after we'll look at the Voltas.
Thank you very much for joining in. Get into a break. On the other side, Manisha will join in to talk about commodities. Stay tuned.